after these funds were launched, particularly the last 3-4 months have been highly volatile with so much of uncertainty, and these categories of SIF suits perfectly well for such uncertain times or volatile times. We are only going to talk about broadly two categories which look really attractive for small investors, which is the hybrid long short and the equity long short categories. In the equity long short categories, there are three main subcategories, which are equity long short, then you have the equity X top 100 long short, and then it is the sector rotation long short. We discussed that in hybrid there are the active asset allocator and the hybrid long short. So the relatively conservative category is the hybrid long short. You have a potential to make a slightly more than FD returns on the upside, and the downside can be protected by the up to 25% unhedged derivative exposure.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Specialized Investment Funds, SIFs. This is a new asset class or a new investment option which has come up, and as of now it's mostly manufactured and distributed by mutual fund houses. What does it have for you and which kind of investors does this suit? This is what we are going to see from this video. First of all, most of these funds, or the oldest of these funds, are only about 6 months old. This is a very recently launched investment option. So if you are looking for track record, you don't see much of a track record. The longest or the oldest fund in this category is only 6 months. So this is the caveat with which we are starting. You don't have a long track record, but if you still want to test it because this is looking interesting and this is looking suitable to you, then you can without much of a track record. Who should invest in this? This is basically for investors who have at least 1 crore of rupees in financial investments. Why? Because the minimum investment required for a SIF or a specialized investment fund is 10 lakh of rupees. So if you have a 1 crore of financial investment, one SIF will take 10% of your overall investment, which is 10% exposure. So at the most, you can look at 10% exposure into SIFs, not more than that. And I would still suggest not more than 10% strictly if it is up to 1 crore, and even if you have 5 crore of money, it's not necessary you should still put 10% there. You can stop with 20-25 lakhs, not more than that, because it has to be really time tested. We have told clearly this is for HNIs. Basically HNIs who can invest at least 10 lakh in a single product. Then what is in it for you? There is an element of downside protection through the long short exposure, which is the derivative exposure, particularly unhedged option also is there. You have the option of taking naked exposure in derivatives. The fund manager has. What happens because of this? In volatile markets, if fund managers are able to manage exposure with shorts very intelligently, these funds can outperform a regular mutual fund product in the comparable category. We are only going to talk about broadly two categories which look really attractive for small investors, which is the hybrid long short and the equity long short categories. In the equity long short categories, there are three main subcategories, which are equity long short, then you have the equity X top 100 long short, and then it is the sector rotation long short. The first one, the equity long short, invests minimum of 80% in equity and equity related instruments, and the equity portion is in the large caps, and they can take up to 25% derivative exposure into various market caps. The second one, X top 100 long short, takes exposure into mid and small caps. Minimum 65% should be invested in equity and equity related instruments, and the derivative exposure of 25% has to be in mid and small cap category. Obviously, this is slightly riskier, aggressive, and of course there is a potential to make higher returns if you are willing to take that higher risk in this category as compared to the previous category. The next one is even more aggressive, sector rotation, which means it dynamically rotates the sector exposure based on the changing dynamics and the sector rotation which happens in the market. Here again, minimum of 80% has to be invested across the sectors and equity related instruments, and obviously this has the highest risk among the three categories and also a potential to make higher returns, but can be very risky, not for all investors. In the hybrid category, there are two subcategories. One is the active asset allocator long short. This particular category has the option of investing in various asset classes. It's called, you can call it as a multi-asset class category, where you have the exposure and option to invest in commodities, equities, debt, REITs and InvITs. This fund also can take maximum of 25% exposure to unhedged derivatives. The next hybrid category is hybrid long short. This has exposure into equity and debt, and of course the derivative exposure. This particular category is mandated to take at least a 25% exposure into debt instruments. Compared to the equity long short categories or strategies, this category, which is the hybrid strategy, looks relatively suitable and is relatively suitable, relatively conservative investors. If you are looking at a very aggressive kind of a category or strategy in the SIF, you have to either choose the equity X top 100 long short fund or the sector rotation long short fund. These are very aggressive in nature. The upside is managed and probably to the best potential possible through the equity category, which is mid and small cap in the equity X long top, and through sector rotation, normally it is maximum of 4 sectors. So the upside is captured by this aggressive exposure into these equity segments. The downside protection is attempted effectively by the 25% unhedged derivative exposure. That's how this is supposed to be a very aggressive category in this for capturing upside and also limiting downside. But relatively, if somebody is looking for a better than FD or a hybrid exposure, but with a little more potential to limit downside, then the hybrid long short. We discussed that in hybrid there are the active asset allocator and the hybrid long short. So the relatively conservative category is the hybrid long short. You have a potential to make a slightly more than FD returns on the upside, and the downside can be protected by the up to 25% unhedged derivative exposure. One good thing which has worked in favor of this particular category is after these funds were launched, particularly the last 3-4 months have been highly volatile with so much of uncertainty, and these categories of SIF suits perfectly well for such uncertain times or volatile times. This is because they have the potential to limit the downside better as compared to a regular mutual fund product because of the unhedged derivative exposure. How have SIFs performed since their launch? In the last 3 months, it is slightly from before the war till now, there has been a heavy amount of volatility. Similar is the case in the last 15 days. Both in the last 3 months as well as in the last 15 days, the top 1 or 2 funds are SIF. So as their structure favors them to manage downside better in these volatile times, compared to a regular hybrid mutual fund product, SIFs have outperformed. This can happen in most volatile market phases. So this volatility has given a lot of attention to these SIFs, though they had a very slow start. As we speak, this category has crossed 10,000 crores of AUM. So the oldest funds have garnered 1,000, 2,000 and 3,000 crores. And if volatility continues, there is a lot of money which can chase SIFs. But if you want to invest, if you have missed any of the risk and opportunity portion which we have mentioned, if you have missed the risk and opportunity portion which we elaborated, please go back, listen through carefully, and then decide based on the corpus which you have, the risk which you can take, whether you can opt for this. Now, if you are confused, you have the money but not able to decide, you can reach out to us. We can help you with the information about whether you can invest in SIF, whether your risk profile suits to investing in SIF, and if it suits, which are the right set of SIFs. There are many fund houses which have launched SIFs, and we can construct the best SIF portfolio for you, which will be a decent portion within your overall portfolio. Please reach out to us in the numbers which you see below, and we will help you and provide the right solutions to allocate investments to SIFs.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.